We got economic data yesterday, and as you can see, the economic data spooked the market, and you can see that the bubbles are all red. Every single one of the bubbles is red. Bitcoin went all the way down to 94,432. The truth is, though, I'm not worried. In fact, not only am I not worried, but I'm actually going to start buying today. I'm going to show you exactly what I'm buying today. I'm also going to show you exactly why I'm not worried. And hopefully when you see why I'm not worried, then you also won't be worried, and we will buy together today on the show. I'm going to show you exactly what we're buying today. So if that sounds good to you, subscribe to the channel immediately, smash the like button. Let's get going, guys. You know, I want to say that this market dip was so predictable. It was so predictable. I predicted it over here where I said, today is a warm-up for what Monday will be like. When people get back to work, the majority of people get back on Monday. What do? They come back on Monday. They bid the market up like crazy. Guess what happens on Tuesday? They get flushed out. I mean, it was absolutely predictable. That's one of the reasons why I'm not actually too worried about. But I do think that we need to talk about why the market got spooked. We need to analyze the data. We need to interpret the data. Once we interpret the data, we need to decide whether or not we are worried. And in case you don't feel like watching the show at the end, I'm not worried, okay? I'm not worried. So I'm not worried about this market. I'm going to start buying. I'm going to show you exactly what I'm going to start buying. All you need to do is destroy the like button. I see there's only 237 likes. You know, a lot of people don't know we're back from vacation yet. Or there's another theory. The other theory is that they know we're back from vacation, but they just don't want to come to the crypto market because there's nothing for them to do in crypto because the markets actually have been boring. I don't know if you saw the other day, but I saw that TZ tweeted, he said 100K is boring. Well, now 95K is boring and a little bit painful. Anyway, let's get on with Alpha. I'm reminding you again that if you haven't subscribed, subscribe. Let's see. 1, 2, 3, more subscribers. Amazing. Let's go. All right, let's go. Let's talk about what actually happened yesterday. We had quite a big flush out actually on Bitcoin. We edged up to like 103,000 and then we went all the way back down to like 94,500. Quite a big liquidation, about $700 million worth of liquidations destroyed in that little move. As I said, I did kind of predict that those people were going to get destroyed because the people that came in were the people that usually get that came in. They were. It's like on their vacation they realized, look, we're really unexposed to crypto. What do we need to do? We need to come back on Monday morning and we need to start buying up like crazy. Fast forward to Tuesday. They get flashed out. I mean, anybody could have told you that was going to happen. But look, if you are looking for a reason for this to happen, and by the way, you shouldn't be looking for a reason for this price dip because this price dip was very much in the charts. You can actually see that every month, in the beginning of the month, we dump and we usually recover slightly after the 5th or 6th, usually about the 8th, we actually start recovering. But you know what, if you do want a reason, and I know some of you just need a reason to justify why the markets have been going down, today I'm going to show you all the reasons why the market actually went down. Truth is though, that none of these reasons actually matter. It's very cyclical. Not only is it cyclical for every single day, in every single month in the markets this year, okay, June, July, August, September, October, November, December, and January, all exactly the same. Beginning of the month goes down, and then we start to recover, and we end the month up. Generally, we generally end the month up higher in this part of the bull market. But anyway, for those of you who still want a reason, let's go through the reason. Let's go through the economic indicators that actually spooked the market yesterday. Because I did mention to you earlier that what happened was you had economic indicators. Those economic indicators spooked the market. That spooking the market caused the market to go down. Now I'm going to go through the economic indicators with you just so we understand what's going on, because we do need to understand. We can't just jump into the markets without understanding the actual data. So let's look at the actual data yesterday. We got 2 data points that came out yesterday. Get this, right? Both of those data points indicated that the economy was very strong. Therefore, the markets went down. I swear to you that that's the case. 2 bits of economic data, both bits of economic data said the markets were strong and the markets went down. Go figure. Anyway, let's look at the economic data. The first bit of economic data that came out was the ISM. What is the ISM? Well, if you look at what this says, the ISM manufacturing index is commonly known as the IMX Purchasing Managers Index, which is a gauge of the level of economic activity in the manufacturing sector in the United States. So what they're measuring is how strong is the manufacturing sector in the United States. It's kind of like a precursor to the strength of the economy or the strength of the GDP. Now, what do we know about the ISM? We say that if the ISM is bigger than 50, it means the economy or manufacturing is expanding. If it's smaller than 50, it means manufacturing is contracting. Now, let me ask you a question. Where would you rather be? Would you rather be in an expanding economy or would you rather be in a contracting economy? I mean, naturally, you're going to say, I'd prefer an expanding economy, right? Well, that's what the market got, because what we got is guess what? We got 54.1 on the ISM and we were expecting 53.5. So in a nutshell, simplistically, all that happened was that the manufacturing was it was hotter than the market expected. The economy and the manufacturing were hotter than the market expected. Okay, so why is that bad? Well, the reason why that's bad is because if the manufacturing and the economy is hotter than expected, then why should the Fed cut interest rates, right? The Fed's only going to cut interest rates if the Fed feels that the economy is slowing. And if the economy is not slowing, then the Fed's got no reason to cut interest rates. Now, again, that shouldn't shock you. Why? Because you'll remember when Jerome Powell spoke at the FOMC meeting, in the last FOMC meeting, he said, we're probably only going to have 2 rate cuts next year of 25 basis points. You remember the dot plot, the famous dots that we drew, or that they drew, because they got nothing else to do in the meeting, so they stand there and they put little dots on their paper. It's like the meetings here at Banter. Anyway, so what happened? The Fed, so now the market's starting to worry that the Fed won't cut interest rates, which is, by the way, exactly what Jerome Powell told us at the last FOMC meeting. Remember that last FOMC meeting? And that began the shock of the markets. Well, you can kind of say that this is the continuation of that meeting. So that's the first bit of economic data that came out. The second bit of economic data that came out, believe it or not, was the US jobs opening. Okay, so this is it's called the JOLTS report. It's the job openings report. And what this shows is how many jobs are open in the United States. They estimated that 7.74 million jobs would be open and 8.09 million jobs are open. What does that mean? It means the economy is strong and there are lots of job openings and people want people to come back to work. But the market says, hold on a second. If there's lots of jobs, it means that the economy is strong. And if the economy is strong, then, well, the Fed doesn't need to cut interest rates. And so all what happened yesterday was we got 2 indicators, and those 2 indicators just told us that the economy is much hotter than we think the economy is. That's pretty much what happened yesterday. And so let's look at the implications of that. The first implication of that is that now people are starting to worry that the Fed's not going to cut interest rates as aggressively as they should. And you'll remember that for the whole of next year, we anticipated, or the Fed or the market is pricing, and let's just quickly try and get this data live. Let's just quickly refresh that and get the data live. Here we go. So if you look at what the probabilities are looking like, right now, it seems like the market, okay, so here the market's pricing the first rate cut in May, but actually the market's pricing the first rate cut actually to be in June now. And so basically, you got a situation where the market's saying, look, now because the economy is so hot, probably the Fed's not going to cut interest rates until at least June or July. And that's starting to worry the markets, right? As they call this guy the Fed Whisperer, his name is 𝗕𝗓𝗓𝗧. He says, with the rise in US jobs opening in November, the 3-month moving average ticked up for the first time. And so for the first time, we're showing that there's more jobs open for more people, which means the economy is pretty hot. And so hot economy means that the Fed doesn't have any reason to stimulate the economy by cutting interest rates. And what that did yesterday was it sent the market into a tumble. So let's quickly just look at what actually happened to the market. Okay, let's quickly let's just quickly go back here. Let's just check the SP 500, which was also down yesterday. So you can see the S&P 500 took a smack yesterday. You can see that over here. It went down about 1.6%, and the Dow followed, and a whole lot of other followed. And of course, Bitcoin went down in this absolute meltdown, and that's pretty much what happened. All right, so let's just quickly summarize a few things. The first thing is, as Mr. Crypto says, he says, this is why Bitcoin is dumping. The US economic data surged. Job openings beat expectations. Both of these are bad for risk assets, and therefore people started to actually get worried. What also happened, though, is that the US 10-year bond yield. So this is people buying US government debt that matures in 10 years. The bond yield went up. And in fact, if you look at the US 10-year government bond yield, you can see that right now it's trading at 4.7%. It's very, very, very high. In fact, the last time it was this high was around April. And before that, the last time it was around November 2023. So what this shows is that the market says that the market, if you want to take debt, if you want to take US debt, the market's paying you 4.717%, which means that it's going very, very much up. Now, what happens when the rate on US debt goes up? People say, hold on a second. If I can loan money to the US government and I can get a guaranteed 4.71%, I'm going to do that. And what they do to do that is they buy dollars. And that's why what you can see is that the 𝗕𝗘𝗖𝗖𝗢𝗙 is going up. The dollar index is going up because if people want to invest in these US T-bills, then what they need to do is they need to buy dollars to do that. And so now what you've got is you've got the 𝗕𝗘𝗖𝗖𝗢𝗙 going up, the dollar index going up, and you've got the 10-year treasury yield actually going up. But what the market is telling you is people are worried that the Fed pivoted too soon and that the Fed pivoted to start lowering rates before they had inflation under control. And that's really everything that the market's saying to you. The market doesn't like uncertainty. The market doesn't like being in a position where they don't trust the Fed. And what they're saying is the Fed may have started to lower interest rates before the inflation problem was under control. And now you've got a hot economy on the other side, which may actually start pushing inflation up. And so the Fed is now disconnected with the markets because the Fed is lowering interest rates, but the markets are increasing interest rates. Specifically, this is the most important part, specifically, the increase in interest rates is happening on long-term debt. This is where the key point is. That's happening on 10-year debt. That is pretty much what's happening in the markets right now and what's spooking the markets now. There's a disconnect between what the Fed is saying and what the market is actually telling you. And that's the part that's actually spooking the markets right now. Now, generally, when you get expectations of high interest rates, then risk assets generally, then the 𝗕𝗘𝗖𝗖𝗢𝗙 actually goes up because the dollar gets stronger, because the interest rates go higher. But gold, which is known as the inflation hedge, usually goes up. And as you can see, gold is actually starting to go up. And that's playing out pretty much textbook. One thing you got to remember is that generally, when the 10-year interest rate goes up, risk assets go down. And when the 10-year interest rate goes down, risk assets go up. So you can kind of see it quite well in the charts here. As the 10-year goes up, the risk assets, in this case, Bitcoin goes down. And generally, you can actually see that generally, there's that trend. You can see it here. Here, the 10-year starts to go down, and the risk asset actually starts to go up. And if you did that against the SP500, maybe we can quickly just do that against the SP500, you can see that that is generally the trend that actually happens. As the SP500 goes down, the trend in this usually goes up. So you can kind of see that is quite normal. The other thing that happened, which is, I think, pretty strange, but anyway, we'll go through it anyway. The other thing that happened was, as this started to happen, the yield curve uninverted. Now, I'll spend 2 seconds talking about what an inverted yield curve is. An inverted yield curve is when long-term debt is cheaper than short-term debt. So like, if I said to you, loan me money for 10 years, and I said to you, loan me money for 2 years, theoretically, you should charge a higher premium for the 10-year loan because there's more time and therefore there's more uncertainty. What we had up until now was we had what they called an inverted yield curve. An inverted yield curve is a phenomenon where the bond market short-term rates are higher than long-term rates. And it's considered unusual because under normal circumstances, investors tend to be compensated for locking their money for longer terms, right? And so generally, get this. Generally, when the yield curve uninverts, that is usually a sign that a recession is coming. And so now the market's starting to panic about this potential recession that's coming. Strange, right? Because all the data showed us yesterday that there's no recession coming. In fact, that the economy is too strong, and therefore the Fed can't cut interest rates. Now, the reason why I think that this is a crock of bullshit is that when the economy is strong, right, the interest rates go up, and that weakens the economy, and then sometimes we go into a recession. And so I wouldn't worry too much about all these naysayers that say, look, the yield curve's uninverted. Yes, of course. If you have a very strong economy and you tighten, then chances are you will slow down, and maybe you'll have a recession. But sometimes you don't have a recession. Sometimes you have a very short recession. And sometimes the market sees right through that recession, which is what happened in the last recession. So, long story short, we got a whole lot of economic data. The economic data showed us that the economy was much stronger than it should be, or than they wanted. Therefore, the Fed can't cut interest rates. And therefore, the 10-year yield actually went up. And the 10-year yield actually went up, made the Dixie stronger, and that made risk assets a lot weaker. That's pretty much what happened yesterday. Okay. Now, that happens. You understand this, right? If you understand this, just say yes. Just put thumbs up. If you don't, just put thumbs down, and then I'll do it again. So, all right. So, now, when this happens, the minute that the markets start to go down, you know what happens? The geniuses come out, and they start to plot the death graphs. I warned you all. 2013 published Rich Dad Poor Dad. The biggest crash in stock market history is coming. That crash is now. How did I know this giant crash was coming? Because in 2008, our leaders, led by Fed Chairman Ben Bernanke, paid himself and his bankers billions in bonuses, while millions of moms and pops lost their homes, jobs, and savings. We're in for the greatest crashes. There's a massive crash coming. Crash. Then the other geniuses come out and they plot these charts. And for those of you who can't see this chart, let me make it bigger for you so that you can see it. This is an 8-year trend on Bitcoin prices. And you can see that every time on this uptrend, every time Bitcoin touches this line, we get a correction. And this guy is now calling it back to $30,000. Wow. Geniuses. All the geniuses come out. When the market goes up on a massive run. Market takes like a 2% day pullback. People are calling it back to 30,000. This guy's talking about the biggest crash in history because the market's following a similar path. Can you believe it? I'm going to show you why I'm not worried about any of these. Okay, so I'm going to debunk these one by one for you. I'm going to show you why I'm not worried about any of these. Let's start off with this one over here. This guy who plotted this chart over here. He's got a point. If you do take that trend line over the last 8 years on the weekly, and you draw it up here, yeah, you actually do get a downtrend. But let me show you why he's over-exaggerating. Number one, look how many weeks you can stay above that trend, or you can challenge that trend. Look how many weeks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. This is like at least 15, 20 weeks, right? This is like 3, 4 weeks. This can carry on for a long time. Number two, we can actually break out of this uptrend. Number three, he is exaggerating all of this to almost say that there's not going to be a higher low, which is what there was last time, right? So I think even if we crashed, to go down to $30,000 is absolutely ridiculous. But I also think that there may be a long time before we can actually break through this. That's number one. Number two, the reason why I don't trust Robert Kiyosaki. I don't know what this guy's on. But this guy's been calling crashes ever since 2011. Crash. Every time I go to his Twitter timeline, crash, biggest crash in history, crash only beginning, crash. Garbage. Naysayers. Ignore them. Mute them from your timeline. I don't follow him anymore. Another reason why I'm not scared of this economic data. One of the things that came out in the economic data was the jobs report, right? And the jobs report said there was a lot of job openings. How many companies do you think that there were in the United States that said, look, before we advertise for new jobs, before we look for new jobs, let's wait and see what the outcome of the election is. And if Trump wins, and Trump is very good for the economy, then we will hire. And if Trump doesn't win, then it's a Democrat economy and therefore we won't hire. How many companies do you think did that? And that's exactly what happened. So probably one of the biggest reasons for the job openings is because companies are starting to get more bullish and therefore they're opening more positions because Donald Trump is in power. Also, remember that Donald Trump has said that he's going to bring manufacturing onshore. And there are a whole lot of companies that are trying to front run this. They're trying to build manufacturing facilities so that when Trump brings the manufacturing onshore, they can actually capture the lion's share of that policy, right? And so I think that a big part of this job openings was actually the fact that a lot of companies actually delayed their hiring position. Also, when it comes to economic data, there's a lot of economic data that actually comes out this week. So I'm not blind about this. I know that on Friday we have two big job reports coming out on Friday. Then next week we have the CPI, which is coming out. And so what I want to do is I want to look at all this data in totality before I actually make any kind of thing. Also, all of this data that we are looking at now is all historical data. We're analyzing historical data and the market is looking forward. But do you think that it is logical to analyze historical data under a Democrat regime with Democrat principles and policies and to extrapolate that same data forward with a change in regime, with such an extreme change in regime? I don't know if you guys heard Trump yesterday afterwards, but listen to what he said.
We are inheriting a difficult situation from the outgoing administration, and they're trying everything they can to make it more difficult. Inflation is continuing to rage, and interest rates are far too high. And I've been disappointed to see the Biden administration's attempt to block the reforms of the American people and that they voted for. We had a landslide.
Now, I don't know about you guys, but I think Trump has come into quite a difficult situation. But I think Trump's got a plan. His plan is very simply, he wants interest rates lower. He wants inflation lower. How's he going to do that? Well, number one, he's cutting government spending. And number two is he's bringing a lot of manufacturing back onshore. That is the Trump strategy. Now, the question is whether or not you believe in the Trump strategy. If you believe in the Trump strategy, why would you sell now before he comes into power and has the ability to put his strategy into place? Why would you sell based on the historical data? That's why I'm not selling, because I just think that anyone that is doing that is making a mistake. I'm not saying there can't be a correction. I'm just saying these are the reasons why I think there won't be a correction right now. Also, remember that right now we are at a point, a very, very, very unique point in time, where let me try and show you something here. Where is our beautiful chart? Is it this one? Let me actually change this symbol to the Dixie. I want to show you something. We are now at a point where the Dixie is very, 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 very high. In fact, right now the Dixie is trading at 109,153. It hasn't traded this high since November 22. And that was on a downswing. On an upswing, it hasn't traded this high since September 2022. What does this mean? Generally, when the Dixie gets strong, risk assets go down. So you can see, if you look at the S&P, when the Dixie goes up, the S&P usually collapses. So here we had the Dixie go from 105 to 109, and at the same time, the markets fell. The S&P fell by about 20%. We're in quite a unique scenario. Actually, not that unique. It's happened once before, and I'll show you. The Dixie has been going up. If you look at what's happened to Dixie, if you look at when the elections actually happened, so here the elections actually happened, the Dixie was at 103, and the Dixie is now at 109, right? You can sit on this axis over here. That means that the dollar has been getting stronger, while at the same time, risk assets have been going up. So the Bitcoin we know has gone up from 65,000 to 100,000, and the dollar has strengthened. Now, question is, what would happen if the dollar weakened suddenly? So what would happen if all of a sudden the dollar weakened? well, then you would get risk assets going higher in price, right? Now, let's look at what happened in the last elections. If I look at the last elections, this is the last elections, the 2016 elections. The Dixie went very, 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 very high between between when Trump won and the inauguration. And then Trump said the dollar is too strong. Now, Trump's smart. As per this tweet, Trump's quite smart. we'll quickly read it together. It says the last time Trump said something was too high, it was $1 in 2007 before his inauguration. Our companies can't compete with them now because our currency is too strong and it's killing us. Last year, he also called the recent strength of the dollar a tremendous burden on U.S. businesses. Trump understands the impact of a strong dollar, and the same logic applies to high interest rates to suppress imports, hurt corporate earnings, and slow economic growth. And so what Trump is going to do, he's probably going to do the same thing that he did in the last elections, and he's going to trigger a slight decline in the dollar so that the US becomes more competitive and that more people can actually buy stuff in the United States and manufacturing increases and he can bring the jobs in there. And so if this repeats itself, when Trump actually comes in and can implement his policies, we get a slightly weaker dollar. We get inflation hopefully down. If he can cut government spending quickly enough, then inflation actually starts to go down and everything starts to play out exactly as we thought it would happen. Okay, so that is why I am not worried. So as I showed you now, I debunked for you all these reasons why I'm not worried. And let's just quickly look at how the market's opened today. Okay, the market's down 0.3% today, so it hasn't recovered yet, but I think the market actually will recover. Now let's go into a couple of other reasons which I'm not worried. First of all, as I said to you, guys, this has happened every single month. Pretty much all year round, around the 5th and 6th day of the month, we start dumping, and then it bottoms out around the 12th. In fact, if you look at the last two inauguration years, in Jan 2017 and in Jan 2021, guess what? We got a dip in the beginning of January. It was called the Pre-Inauguration Dip. It's actually quite well documented. In fact, you can see that in most months, specifically, in most months, we start in the beginning and we bottom around the middle of the month and then we actually start to go up. This is the corrections that generally started in January. You can see that every time in around mid-January, beginning to mid-January, we actually get a correction. In 2017, we had a correction that started 15 days before the inauguration, and the correction lasted for 7 days, and then we went much higher. We actually went parabolic after that. The inauguration's on the 20th. Yesterday was 15 days before the election. And this correction lasted 7 days. This one was quite a big correction, I must say. I think if I remember correctly, this one was about it's a 37% pre-inauguration dump. Don't think we're going to get a 37% pre-inauguration dump, but I think we could get a bit more of a dump. In 2021, again, post-halving year, post-election year, we have a correction that started 12 days before the inauguration and it lasted 14 days. So not only is this normal for the beginning of the month, not only is this normal for every single January, but it's also very, very, very normal for every single inauguration year. So not worried because just on the charts, the numbers are kind of adding up. All right, so then the question is, am I actually starting to buy? What am I starting to buy? And why am I confident enough to actually start buying? So let me show you why I'm confident enough to actually start thinking of buying. I'm not aping all in. In fact, we're going to do some buys together on the show today. I did ask you guys to open a Bybit account yesterday. If you open a Bybit account, great. You will be trading with us. If not, you can always open it again. And if you do open an account with the link here, I could fund your account. There's a link at the bottom here. I could fund your account. I'm going to fund 10 accounts that are opened from today with $1,000 each. So you can open a Bybit, Bitget, or Blowfin account. If you open an account in the next couple of days, I will be dropping I may drop $1,000 into your account in the next couple of days so that you can trade with us. Anyway, let's look at a couple of things. The first thing is, let's look at the RSIs. On the short term, the RSIs are very, very, very oversold. In fact, they haven't been this oversold since November 5th. But I'm not a short-term trader. I don't really care about the short term. On the longer term, on the daily chart, the RSI still hasn't bottomed. There's still quite a way to go on the bottoming of the RSI. In terms of fear and greed, you'll remember that I said to you that for me, a correction is when the fear and greed drops by about 30 points. So generally, if I look at corrections, the fear and greed has to drop by about 30 to about 40 points. 40 points is a little bit more comfortable for me. If I look at where we were in the beginning of the cycle, we were at about 94, and right now we're on about 70. So from here, this tells me that there could be some more way to go. But remember, I'm not trying to catch the bottom. I'm just trying to be in a position where there's more upside in buying than there is in selling. I know also that seasonality is on my side, specifically when it comes to altcoins, right? Like I know January is not a great month for Bitcoin, but I know February is an amazing month for Bitcoin. And if I look at ETH, well, I know for sure that for ETH, the first quarter of the year, January, February, March, are the most incredible, and specifically in a election year. What I'm waiting for is I'm looking at a couple of things. The first thing is I'm waiting to see what the ETFs do now. So up until now, the ETFs have had very positive flows. Let's wait and see what the ETFs do in the next couple of days. The second thing that I'm waiting for is I'm waiting for inflation, right? I'm waiting to see what the inflation numbers are going to be next week. Next week is a big week. There's CPI coming out next week. I'm waiting to see what happens with the CPI. And then later on in January, there is an FOMC meeting. There's an FOMC meeting on the 29th of January. So I'm waiting to see what happens with CPI, and I'm waiting to see what happens with the FOMC. As it relates to the FOMC, I'm not expecting anything. I'm not expecting a rate cut, and I'm not expecting the Fed to start increasing their balance sheet. I'm not expecting the Fed to start increasing their balance sheet. You'll remember that when the Fed does start increasing their balance sheet, that is when the true alt season actually begins, right? So here, you remember this has happened in 2020 and in 2022, when they made an announcement that they're going to increase their balance sheet. That is actually when the alt seasons actually begin. I don't believe that that's coming yet, specifically because the economy is so heated. I don't believe that the Fed has any reason to start increasing their balance sheet. So I don't think that's going to start happening in January. The good news is, though, that the longer it takes for the Fed to increase their balance sheet, the longer this bull market actually runs. So remember, we need to wait for the liquidity, and we need to wait for the alt season. And if the Fed only start the liquidity in March, that could actually give us a much, much, much longer bull run, which is actually what we wanted. So that is what my thesis is. Now, let's talk about actually buying in this market. So when you look at the bubbles, and by the way, guys, if you haven't yet downloaded the new bubbles or tried the new bubbles, the new bubbles is actually live now. I don't know if you've seen this feature. Josh actually coded this yesterday with his own hands. But the price movements in the live prices are actually live. So you can actually see that as people buy and as people trade, you can see that the bubbles actually start moving live. So unlike any of our competitors, and unlike how we used to operate in the past, where the bubbles where we had to refresh every 30 seconds or 2 minutes, now these trades are actually happening live. You can see like these prices are actually moving live as we go. And I think we're the only providers in the market that can actually do it. So if you haven't yet got Banter Bubbles, go and download Banter Bubbles. All right, what am I buying? Well, if I look at the charts, there are a lot of tokens that have taken a very, very, very big hit, right? And I think that there's some that are probably worth looking to buy, right? So I'm not really playing the meme coins. So I'm not going to touch the goats and all of those. It doesn't really interest me. What I'm trying to look for, if I'm starting to buy now, I'm starting to look for because I think that this market can go slightly down, but if it doesn't, I don't want to miss it. I want to be buying tokens that I feel very safe in. And the tokens that I feel very safe in are not the new shiny objects. The tokens that I feel safe in are the tokens that I know that have survived multi-cycles and that are going to do well this cycle because of the thesis. There's a good thesis, right? Show you one or two of those examples. Like one example, which I think is amazing, but I don't know how to get the entry, is Phantom. Phantom has absolutely been destroyed because of this buy the rumor, sell the news migration to Sonic. Problem is that this whole Sonic migration is very confusing for people, right? You can take your Phantom, swap it for Sonic, but if you're on the exchange, will the exchange actually trade your Phantom for Sonic? No one knows. And in fact, I was going to buy Sonic in the new Bybit account, which I actually set up, right? But I didn't. And the reason why I didn't is because they delisting the Phantom token and you don't automatically get a Sonic token. And so if you have money to buy spot, I'm not going to buy spot, but if you have money to buy spot, buy Phantom. Because when this whole migration is over, buy Sonic. Because you're going to pay 68 cents for Sonic. That's like the deal of a fucking lifetime. But I'm a leverage DGen trader, and I'm not going to be buying shit that's not on leverage. So that one I would be buying. If I could buy Phantom on leverage or Sonic on leverage, I would definitely do that. The next one which I would like to buy, but I think I'm looking for a slightly bigger discount, is to buy Curve. Why? Because I've got a big stablecoin thesis, and Curve is like my number one stablecoin play because it's the exchange that allows you to swap between stablecoins. They've just implemented support for Sonic, by the way. And then there's Convex, which is the reason why I like Convex is because it's a derivative effectively of Curve, right? So Convex is effectively Curve plus Prisma plus FXS plus FXN. That's pretty much what it is. And Frax is something that, so Curve is a stablecoin play, and Frax is, you want to call it a BlackRock play, because BlackRock have integrated, have used or are using Frax. And so basically, that's another one which I would actually be looking at if I was starting to nibble. Then I'd start looking at some other value, like the one that's really a screaming buy for me now, and I think I'm going to actually execute that trade right now in front of our eyes, is I'm going to start nibbling on Rune. So I don't want to spend, I've got $250,000 in this account. I want to spend a maximum of $50,000. Okay, goodbye. I want to spend a maximum of $50,000. The first position that I'm going to take is I'm going to take $20,000 worth of Rune. I'm buying $20,000 worth of Rune. Don't show me this window, just confirming that it is crossed. Yeah. So I've got myself, my first position here is I've got $20,000 worth of Rune. That's 5%, or sorry, that's 10% of my $5,000 value, $20,000. It's a it's like 2% of my portfolio, right? It's like, yeah, 2% of my leverage is actually now in Rune. Let's see what else is actually worth buying here at the moment. Let's see what's good and what's cheap at the moment. I want to get some SUI because I think SUI's got amazing relative strength in the cycle. But the question is it under $4.50? It's not under $4.50. So I don't think I'm actually going to touch it. What else? What else are we looking at here? Let's have a look here. Is there anything? Phantom, Curve, SUI, Rune. Curve, I'm going to wait a little bit. Let's buy, for today, I'm going to buy Rune. If you're following these transactions, I think today, let's just buy Rune for now. Also, if you're in front runners, I'll let you know what else I'm buying. If you're not, I will let you know on my Twitter as well what I'm buying and when I'm actually buying it. I also think maybe 𝗪𝗪𝗪 has got the big catalyst coming up now. Let's wait a little bit before we do 𝗪𝗪𝗪. So for now, loading up on some Rune. Remember, I'm not buying the risky stuff now. Even though the risky stuff has actually been very amazing for us. I don't know if you've been following our AI calls, but they've been really good. I mean, hats off to the researchers. We took a bet on the AI agents. We've gone really all in on the AI agents, and I think that bet's starting to play off. One that we spoke about yesterday was Citadel. Remember we spoke about yesterday, it was at 15 million fully diluted market cap. That's now at 42 million. So if you took that trade, congratulations. That one did very well. We spoke about Ava a few times, but we spoke about it about 2 or 3 days ago. And that one's gone from about $150 to $200 million market cap. Realis World, we spoke about that at about a $15 million market cap. That's now trading at a $23 million market cap. So our AI agents have been really good. I'm going to show you another AI agent which I'm now entering, or which I've entered today. So one that I've entered today is called, the token is called Grift. It plays in the same narrative as this Griffin agent, which is effectively a agent network that can execute transactions on chain. Griffin is only Solana. Orbit is Orbit, which is the Grift token is the Orbit token, which is EVM and Solana. Yeah, this is the token over here. It's got a $60 million fully diluted market cap. It's a cross-chain agent. Griffin works on one chain. Orbit works on 117 chains. So it is pretty good. You can DCA across 117 chains. These are tools that help you use the blockchain. Hold on. Alessandro is sending us something. What is he sending us? Oh, he says 𝗫, which we spoke about the other day, is also done 100%, which is very good. So Grift is one that I'm actually looking at. If you want to go into something riskier and you're looking for something on a different chain and you want to take a real speculative bet, I would put a tiny little bit of money on this thing called Casper AI. This is the virtuals, so to speak, of the Casper chain. So if you want to go onto other chains and you want to go down the risk curve, then Casper AI may be one. The market cap of Casper AI now $17 million market cap. It's actually been pretty strong. It was up at about $20 million earlier. So that's also one. I'm looking at 15-minute charts again. Holy shit. I don't know what's wrong with me. Got to get my shit together here. Another one which we are looking at, I don't think we're ready to talk about. Should we talk about Brain? We won't talk about Brain today. We'll talk about Brain tomorrow when we've got a lot more research for you. I've got two that I'm going to bring you tomorrow. As I said to you, I'm going to start bringing you a lot of these every single day. Remember, guys, two things. Number one, remember, if you want to trade with us, and we're going to be doing trades every day because now the market's down, open a Bybit account, open a Bitget account, open a Blowfin account. If you do, I'm going to be putting $10,000 into people, $1,000 into people's accounts, 10 people who want to trade with us, but you got to open an account any day from today. Also, remember that straight after the show, in fact, in 8 minutes, we have a big announcement on Baked. Massive announcement on Baked. I think you guys are going to love the announcement. If you want to join that announcement, just go to the Baked Twitter page over here and join the spaces. This is the spaces. This is the spaces. There's a massive announcement that we bring. Oh, at least I think it's a massive announcement. You know, we've been looking for something to do with the Baked token. To give it new life, and I think we finally found exactly what it is. Anyway, I will see you guys again tomorrow. Until then, have a beautiful day and trade well, my friends.